Hello, everybody. Welcome back to the Schwab YouTube coaching channel. For our next topic, trading price patterns, I'm your host, Kevin Horner. I want to thank you all for joining me as always. Appreciate you being here, of course. I had a lovely chat with Brent Moores this morning on Trader Talk, and I've got him running the chat today for us during this conversation. So say hey to Brent in there. He'll get to comments and questions that I'm unable to address with you all today. But of course, I want to hear from you. So take the opportunity to drop your comments and questions into the chat, and I'll try to keep an eye on things. And where I can, I'll bring those into the discussion this morning. If you're not already doing so, you can follow Brent and me on X, Brent Moores CS, Kevin Horner CS. We do try to post for you throughout the week. I'm a big believer in posting charts, so that's one of my favorite go-tos, of course, is to find notable charts in the marketplace that could be of interest to you. So I bring those to Twitter and X periodically where I get the chance to do so. So a follow there would be very helpful. And of course, we want to make sure you're subscribed to the Schwab YouTube coaching channel as well. All right, tell you what, everybody, let's get to some disclosures, and then we're going to get into a conversation around various patterns I've come across here the last few days. So we'll start with reminding you that our discussion is exclusively informational and educational. We do not make recommendations here. We do not make endorsements for a specific approach to trading the market. What we do, however, is provide ideas and concepts that traders might choose to employ. Of course, there are, there are always many ways to go about your process. It is your job as a trader to define that process. Our job here is to just give you concepts and ideas to consider, and we'll go forward with exactly that, showing building in your process, risk management, how many dollars to devote, all of that. The specifics behind it is to be built by you, of course. The process is what we want to focus on. That's what we try to cover here as much as possible. Now, it's important to remember that options carry a higher level of risk. They are not appropriate for all investors. In order to trade options at Schwab, you need to be previously approved to do so. So make sure you go through the requisite steps if you wish to be an option trader, and you want to familiarize yourself with the characteristics and risks of standardized options. While we are working in a paper money version of our Thinkorswim desktop application, everybody, it's important to know that if you are the seller of options in paper money, you will never be assigned prior to expiration. There is no early assignment that will occur in paper money. However, this is a risk to those trading short options in a live account, of course. So you need to be aware of the difference between live and paper money accounts. The one other reminder, when you're short a position in options trade, remember that even though your contract may be out the money, not in the money, you can still be early assigned for various reasons. So please keep that in mind. All right. As far as our agenda is concerned, I got a brief announcement I want to highlight for you all. We'll get into a quick look at the S&P 500 and perhaps the semiconductors, which were showing some weakness during the Trader Talk morning discussion. And then we're going to look at our existing portfolio, our example portfolio. We've got a few trades that are active here, and I want to address those. And then, of course, I want to bring some new charts to the table to discuss some ideas as well. So first of all, make certain that you are securing that schwab.com/events page using this as a bookmark. I keep bringing this up, everybody, very simply because we are filling these events quicker than usual. The New York event got filled up almost prior to us even getting the email notification out to everybody. So they're filling up quickly. We do require you to register for the event. We would love to have your attendance on any of the upcoming events here. Chicago, mid-August. We'll be in DC in September for another workshop. And then, of course, the Dallas event is a market drive. That one's going to be fantastic as well. So, as usual, an event face-to-face, an excellent way for you to engage with us coaches and our support groups that we bring to those events as well. So we would love to have you all joining us for any of our upcoming event opportunities. Now, let's jump in to take a peek at the S&P 500. When we talked this morning, we were kind of hanging out at close to break even, but we've made a push. Looks like we are once more trading at intraday new highs, everybody. I'll tell you, tough to argue with the trend here. The group we were worried about this morning were the semiconductors. And if you joined us for that talk, you know that we looked at the 1 hour chart to see if we could find some validating support. And boy, did we ever. That ledge we fell to actually maintained, everybody. It held. So, at least to this point, if nothing else, short-term traders in the semis here can at least position themselves with a belief that there's an opportunity to maintain that longer range trend line, right? This uptrend channel we've been in, and maybe even get back above. I'm going to eliminate all of my drawings here, everybody. In fact, let's change this, actually. I'm going to save my drawing defaults as a new set. So we're going to just call this, how about a rising wedge viewpoint? This way I'll save all my details here. And then I can eliminate the drawing and I can bring it back at a moment's notice if I want to, just by going back into drawing set. And I can then, I can just select the different one. So right now I've got it as rising wedge viewpoint. Really, I needed to do it as default, but ultimately I've got it saved, which is good. So by going back and forth, what I wanted to point out was how we are below the 20-day moving average here for the first time since we recaptured it back on April 23rd. I know many of you who follow frequently, you know that we talk about that April 23rd date because it was the day that the S&P, the day the NASDAQ 100, the day the Russell 2000 all grabbed the 20-day moving average and have held it since. Now today we're below it. It's not the first time because we were below it on the SOX yesterday, but we rallied and finished above it. Very important, interesting action today. Can the SOX recapture the 20-day and close above it at the end of the session today? A close over that would be more of a continuation move or a successful support test for the semis here. So look at that 56.34 for a closing level today at market finish. So just to kind of give you a level to keep an eye on, you want to see this kind of get another 10 to 12 points to the upside so we can close on the 20 or above it. And that could look better than it does at the moment. Still, nice area for a bounce. Let's just not get too head over heels on the support test as it is midday, as opposed to a closing level. All right, so I just wanted to make sure we covered that. Let's take a look at what's going on in our example portfolio here. I have a few notable trades that have been implemented already, and we're going to talk about these, but I did want to look at one, and granted, this is from a different class, so I'll probably talk about this one tomorrow as well. But I just wanted to highlight this discussion on NBIS because I've been monitoring this position. It had been moving through into a range and looking like it was ready to break out. It has had a few attempts into that 55 area. And then on Monday, it had tried to really break out, everybody. This thing traded as high as 58.16. So if you can imagine the way that this candle looked when it peaked was a beautiful, glorious, bright green candle. But if there were ever evidence of reasons why traders will be patient on intraday moves and look for their opportunities on closing bases, this may very well be the one, everybody, because as you can see, even though it was telling us we want to break this one out, we want to get new highs, we want to close at new highs, it did not happen. And since it didn't happen, all we've done is pull back. In fact, you've had a pretty healthy swing here from that peak to the bottom we made yesterday. That is a 15% pullback off of that high. That is not a small amount. So I just wanted to make note of that. I thought it was appropriate in terms of setting understandings around intraday price action versus closing price action and the difference between them, because it can be significant for the trader. It is a little bit notable here, everyone, that now the stock has retreated to the midpoint of this range, right? We've been traded between basically 45 and 55. We had a as our friend Pat Mullally used to say, a fake out breakout there 2 days ago. And now we are in the middle of that $50 or 10-point range, 45 to 55. We're hanging out just around 51. So still need to see new highs closing over 55 to really validate a breakout. But if we get a validated breakout with a close over 55, whether that be for 1 day, 2 days, 5 days, please define that for yourself, everybody, whatever your view of confirmation is, then a lot of traders would tell you that the height of the range we've traded in this case 10 points, would be the estimated height of any rally we could get. So if we can get out of this, that's where the $65 target comes into play as a possibility. So just wanted to talk about that briefly as a reminder of closing values versus intraday values. Now, jumping back to our monitor tab, let's take a look at Rigetti. Rigetti is not performing fantastically. It's up today for us, but if I'm not mistaken, we bought this on a breakout maneuver. So I wanted to peek in on Rigetti. We'll come on over to my chart and let's do, whoops, there we go. Okay, so we've got that $14 breakout. And I believe if I put my trades back on here, show my, there we are, show trades. So we put ourselves in on the breakout day. Do we have an order out there? Let's make sure we've got that added. Show my exits. Okay, we do have a stop. All right, so we don't need to take action as it relates to the Rigetti position here. We are in, we bought on a breakout. We've placed a stop below the breakout day low as a means of, you know, believing that we've got a breakout and therefore we shouldn't get back below that low. So that's notable. The low that day was 1378, and our stop here is in at 1367, 11 cents beneath it. Some of you might say that's a little too tight, even still. Some of you might say that's just right, but whatever your preference, go ahead and make sure you're using something that works for you. But the reason that we utilized this for our exit strategy example is the belief that a breakout that occurs can come back and test the breakout, and if held, we should see trending thereafter. And you'll notice the 20-day in orange is getting caught up into this area. So we are getting closer and closer to a period where we might feel even more confident that the support level that we've established with that stop order can hold, but we have not made a new high that we can validate raising the stop just yet. So going forward, our plan is to sit on our hands until we get a close through 17.5 approximately, and a close through at new highs would give us reason to raise our stop into this vicinity around 14.75, or excuse me, 14.75. And so, that would be basically we'd be raising our stop by $1 a share, which would be getting us closer to a smaller loss, obviously, at this point, hopefully, reminding ourselves that we can't guarantee price in any way on those stop orders. But that would be the plan as it relates to Rigetti. Now, let's peek in on CoreWeave. CoreWeave here, everybody, we have a vertical put situation. So we are short the 145 put, long the 125 put. Our goal here was to profit as the stock went lower, essentially, or as the stock bounced, essentially. Excuse me. So we have the short put with a buy to cover and the long put with a sell to cover order in the platform as it stands. So let's look here at CoreWeave. All right. So the stock is still, let me move our values over here. Stock is still below that 50-day moving average. That's not looking ideal, but it is at a bounce spot, right? We determined that there was some horizontal support, hence the bullish trade here And the hope being that we get some price action upward that would basically tell us that the uptrend is apt to continue. We definitely have some volume to worry about up ahead. You know, in the 155 to 160 area it's where we've seen a lot of volume traded. That could be a spot of significant resistance for us. But, you know, bulls are trying to continue to stay optimistic here, even though we are getting into, today would be day 4, assuming no reversal in today's action. Today will be day 4 below the 50-day moving average. Now, we have held that 125, so many traders are apt to just stay the course as best they can, but a breakdown from here is not going to be fantastic for bulls. So our trade, we've got that limit order out here to sell the put if it goes up, goes to $5. Let's see here. Yeah, it's a good till canceled limit. And then a buy stop on the vertical itself. So the entirety of the trade on the vertical at 18 would be our limit there. So we take a look at what we've done. So because we are short the 145, we have basically built in for ourselves a $20 put spread. Now, we have had the long put move in our favor. So that has mitigated the risk of the trade, as you can see. So we're down, you know, to a total of $255, the majority of which is applied to the short put because the stock has not rallied in the way that our analysis would have suggested or would be benefiting had we, you know, with this particular position. So at the moment, we won't make many alterations or any changes here, but I wanted to revisit it nonetheless. Now, the one we do want to consider looking at here and maybe making some changes on is this, the circle trade. Now, let's see here. Let's get, let's double check where we have it. So we have a 220-240. We are in a bullish call spread, long the 220, short the 240. So we've entered into another $20 spread. Now, this one has moved against us in the sense that we've not gotten the upside action we would be looking for. So our short contract has decreased dramatically. We have picked up $12.75 approximately per contract. So now our contract is trading at $3. Okay. Now, as a reminder, when we put the trade on, the reason to sell the future dated or the future price contract there, the 240 at the higher level, is partly to make our trade more manageable, fewer dollars spent, right? Well, now we could choose to take this trade off, to take the short 240 out of the equation. We do have to know and recognize that we go forward here to approximately, oh, actually not approximately, to August 1, a week from Friday. That's going to be expiration. But let's look at Circle on the chart and discuss how we could choose to take action here. So let's go ahead and I'm going to hide my volume profile for our purposes. There we go. And I'm also going to move us in, everybody, from an hour chart to like this, or into this 1 hour chart. And we're going to just draw the trend line from when things really started to shift. And I think it was right about in here. Let's see if we capture these lows through here. Now, see, this is if we're looking at this here, this action today is uninspiring, right? Because we are below that trend line that some traders might have been happy to be working with on this hourly chart. We are also below these moving averages. These are the exponential moving averages. I have a 33 and a 65 on this chart. 33 is basically the equivalent of the weekly moving average. So the white one, or the light blue rather, is a 5-day moving average. And the 65 is essentially 65 market hours or 2 weeks. Okay, so there's As a reminder, there's 6.5 market hours each day of the week, and that equates to 32.5 trading market hours weekly on a 5-day week. And that's where the 33-hour chart comes from, or the 33 moving average. The idea being, everybody, I'm just trying to give myself or traders in general an idea of where current intraday price action is relative to some appropriate moving averages for a shorter term trader who utilizes a daily chart. So think of this light blue as the equivalent of a fast 5-day moving average, and the pink as the equivalent of a fast, less fast 10-day moving average. So we are below it. Maybe there's a reason to be a little bit cautious in here. The good news is, as it relates to our trade, of course, is that by us putting on a long option position, our worst case scenario is that we lose what we put into the trade, assuming we don't exercise our long call. Of course, with the stock trading, we have the long 220 and the stock is 22 points out the money. We wouldn't exercise that long call. But if a trader, for example, felt that this was an area of short-term support and they simply wanted to cover their short portion of the trade, they could. Because essentially we have picked up $1,200 in profit on that short contract. And the give up that we've had of 23 and a quarter down to 5.5, look, we could keep the remainder, absolutely. All right. We could maintain or at least the opportunity to acquire another, 3.25 to the downside, right? If this expires worthless under 240, well, then we're going to capture that additional 325, 330. But if we stick with the long call, of course, we're going to lose that 560 between now and expiration. Now, just to give you a reminder about how some traders might think about it, given that they have taken the improvement here, they've benefited with the stock kind of meandering and not breaking down just yet, or not breaking upward just yet, some traders would close this out. Take that 240 ledge off the table. That could work. It doesn't mean great things, but what it does do is that if the stock were to bounce in any way, you would no longer be eroding any upside movement by virtue of your short call, right? It is true that we are quite far out the money at this time. We need 40 points on a $200 stock. That is not small. That's 20%. But if we wanted to take it off, we could close just the one side here and then allow the 220 to run, and then we'd have an opportunity to take advantage of any bounce we get. Now, doing so, we would be admitting that we would take look at the difference here. For example, if we held both to expiration and both expired worthless, we're going to give up the difference between these two. We're going to lose another $235 on the position at expiration, assuming we stay under 220. So the trader who covers this short 240 is stating that they are comfortable, instead of losing 235 or 240 between now and expiration, they'd be comfortable losing the remaining 560. Okay, does that make sense to everybody? I hope so, because it's essentially the reason to cover here on the short side is for the purpose of believing that you've got upside opportunity in the 220 between now and next Friday's expiration. It may play out that way, it may not, but the trader who sits on their hands is at worst giving up $230 additional approximately to the downside. And the trader who covers would be risking essentially 565 then remaining between now and expiration. I hope that all kind of makes sense, everybody. So for now, because this is a trade we entered into with a well-defined risk strategy, we're going to stick with it. This is going to give us one more week to come back and discuss the circle trade here on this point, okay? Greg, good point. Let's look at theta here. We can always add in our columns, and if we'd like, I imagine we're not going to see a huge amount. You can always go this way. There you are, everybody. So, yeah, theta and delta on the whole position. Yeah, so tough to validate, right? It is tough to give thought. I tend to lean into the trend more so than I would the Greeks, but we're all different as traders. Okay, I'll just leave it at that. I think looking at the trend as a chartist, many traders would be uncomfortable by this action here over the last 3-4 sessions, but they might also give it the remainder of the day today, for example, and see if we can get a new short-term move that would get you back above the trend line here, perhaps. So not a terrible look at things, but for the trade we've placed, again, because it is a risk-defined approach, for a lot of traders, they're not going to exit a trade that's worked against them. They're going to let it go. And then if they wish to view another window of time, a different series of strikes, etc., that might make sense to consider at that point. Not a bad plan either, V, is to shift the price action. So instead of selling, buy to cover the 240 and maybe you roll lower for the same strike, you can do that. You can also go out to another strike series, another week out, or lower price, or both, right? So you can always go that route as well. I think for today, we'll hold the course. Let's look at some new charts and some new concepts for our consideration here. Have an ascending triangle. So space has become a little bit back in vogue, everybody. We've got Lunar Intuitive Machines, LUNR, had undergone a healthy reversal. Stock was up in that 24 range, sold down to 6. Really, really rough sell. I mean, we're looking at 75% drawdown. Well, the stock has managed to maintain that 50-day moving average. A lot of traders will point to all of these tails along the trend line as being notable, as will they the tails at resistance. Now, today, we're getting a breather. We're right there. So, $13 seems to be important for us on LUNR. So maybe this is one of those trades here, everybody, where it is as simple as a buy on a breakout. Buying with a stop order, for example, to get you into the trade. That can be done in two ways, really. We could do it just buy, stop, and pick a price. So if, for example, we liked today's high at 1337, we recognize it has not maintained. So we may want to give consideration to a couple of ideas here on Lunar. The first would be to take that 1337 high and suggest we'd have to trade through it intraday and then be comfortable making a purchase. So maybe that's a buy stop at 1350 intraday high. That leaves us the risk that we don't close higher at a new closing high, right? That could be a bit of a problem, okay? Doesn't mean it won't work. It just means that some of you would prefer that close. So could we believe in the move? If we did, I mean, you could look at notably, there's big volume in today's move. There was big volume in the move off of support here as well when we had this gap move also earlier, late last week. So some traders might just be noting that we've had good volume and we have dabbled with a breakout. Hasn't yet happened, but that might give traders some confidence to get started, right? So if you want to get started, two ways for consideration. One would be buy nearer the trend line, which happens to be coincident with that 20 and 50-day moving averages down here. And then that way your entrance is near an exit point, right? You might then say we would exit under 1040, for example, because that would be a lower low in price. And some traders might think that makes sense. But by the same token, if you believe that the volume building in here, as we've dabbled into resistance, suggests that a breakout is more likely, well, then the trader might be comfortable with an intraday breakout trade as opposed to looking for a closing value. So let's try a buy stop on some long shares. Thank you for bringing it up here, Marcello. We definitely got a note that earnings are coming August 7. So we got about 2 weeks. We're going to do this, though, in lieu of an option trade. Let's just do this for an equity position. We can do it for, a pretty decent amount, like say $5,000 worth would say about 500 shares would be about $6,400 worth. We would have to decide how much risk we want. So real briefly, if we just look at the peak, we're going to do easy math. We're going to call it 13 down to about 9.5. So if we believe that a breakout could happen, then we would target somewhere in the approximate $16 range. So $13.50 to 16 would be a $2.50 profit scenario, $2.50. And if we risked something under $1, then we'd be in good shape from a risk reward standpoint. So let's look at how we build that, everybody. I'm going to right click. We're going to buy custom, and we're going to apply an OCO bracket. One cancels the other, and that's going to give us a chance to target our upside level as well as put in a protective stop beneath our entrance. We're only going to buy if we can get it to trade through our stop price. Now remember, when we set a buy stop, this is a trigger. When it triggers, it becomes a market order to purchase. And that means we cannot define our entry price at all. So we have risk of gap move, maybe leading us to a purchase higher than we would ultimately like. Now, we're going to go ahead and target 16 for our upside exit. And we're going to leave 12. You know what? We're going to go up to, so the breakout at 13, today's current is 1280. Let's say, let's go to, 1275 or so, which from our entry, and in fact, we're going to go a little beneath it because we don't want to be on that 5-cent increment here. That's going to give us risk from 1350, which we can't verify or validate as our price purchase, but it's going to be risk of about 77 cents, okay? With our upside opportunity about 250. So a little bit better than 1 to 3 risk versus reward. Now make sure we update everything as good till canceled. And again, we're going to do, let's see here. We can do 200 shares. We could even do 300. And we're going to be risking, only a couple $100 approximately, though we can't lock ourselves into that with the stop, of course, because again, no guarantee on our exit price. So let's go ahead and take a peek at that. Oh, before I hit confirm and send, reminder that if you wanted to incorporate a value of time, the trader can always do so by designating the submission time, which might be, for example, something like the last 5 minutes of the session, which would be the 15, 55, and no seconds. So that's 3:55 p.m. Eastern that this would become active, and it would then have to be trading through 1350 as well in order for this order to execute. So that is a conditional. You can incorporate that if one would like, but for our purposes in our example here on LUNR, we're going to go ahead with a standard buy stop with a subsequent sell limit at 16 for the shares and a sell stop at 1273 trigger, and then an execution if triggered at whatever the market price would be, which could be higher or lower than our stop. So there you go, everybody. There's one on LUNR, an ascending triangle potential breakout. Okay, got a couple more for consideration here. Oracle's been moving, and Oracle's been moving in a series of bull flags to the upside, everybody. We've got a breakout followed by a 2-week flag consolidation pattern that then broke out and made new highs. It's been a little choppy, but in the most recent maneuver, we are potentially breaking this flag. Now, we haven't just yet, but I thought it was notable because we did move really well off of this last pullback to this last peak. That was 11.75%. Boy, sometimes, everybody, these lines, you cannot believe the percentage of move you get out of that. It was a 12% pop over 4 days, more than adequate for a trader in many cases. Well, now we don't have the maneuver just yet to validate entry here today, but maybe watch list location on Oracle here. We are off the low, but by not trading through the downtrend line there, some traders are going to sit on their hands a little bit. So if another way to look at this, if I eliminated a lot of my white lines in here, so we've got this brief pullback. If we closed above the high from yesterday at 242.29, well, then some traders would say that's your hold. That's your close above the high of the low day in the pullback, and that would give them confidence to go long. But today's action is uninspiring at this point. Volume a little bit light. Pullback volume was light as well. It could just mean we're not quite ready to get in gear. And it is notable as well that we do have this action going on, right? We've got a downtrend of lower highs and lower lows in our RSI. So we're not getting any validation or leading insights from RSI that might give you reason necessarily just yet, but a thought process for consideration nonetheless. Okay, another one. Found another ascending triangle, everybody. Another one coming up on earnings, except this one is at support rather than at its potential breakout. So another consideration for some traders. Now, again, let's draw in our look at the current trend. We've had a big move to the upside. We've had a fairly obvious uptrend line held and some pretty decent resistance up here in the neighborhood of 48. And the depth from our peak to our bottom, it's about 12 points. And I say our bottom. One way that traders are going to try and get this, and I did this on the lunar position, but they're just going to try and measure the height from the peak to when the stock made its pullback and then again bounced. So we could be very specific, drawing it like so to make sure we capture those lows. So that's right about there. And that means that if we break out, well then, whoops, got a little fat fingered there. Sorry, everybody. That means if we broke out, we'll take our line and we would add it right to here. And that tells us that we might be looking at about 60 to 61 on a measured move. Again, measured moves are just estimations traders will use. It doesn't mean it has to go our way. It doesn't even mean it has to, break out. But what's interesting about this one, if we, let's go ahead and just resize everything a little bit. Our pullback in price has still made higher lows along the way. Additionally, our RSI pullback has come down into the range we would expect, and hopefully a bounce is coming. Now, when I say the range we'd expect, let me just remind you, RSI in bullish markets or bullish trends like we have here can be retreating into a range between 45 and 55 and be then considered to be oversold on that move. Remember, RSI standard is oversold under the 30 line, overbought over the 70 line. But traders who are incorporating the use of RSI in the midst of a strong trend will consider oversold conditions between 45 and 55 commonly. So we have come down into that approximate level, right at the 50 line, right at 47, 48, 49. Now, we haven't gotten a bounce, but are we near support? Many traders would say yes. Now, why is this one attractive more so than a breakout? Well, maybe because the trader could choose to step in right now, being a buyer near support and being an exiter of the trade on a breakdown or a close under the 50-day moving average. Now, that's one way that an equity trader would handle it, but an option trader, of course, wouldn't be as worried about the breakdown necessarily. They could still build a risk-defined trade here with IonQ through the use of options. Perhaps they wish to incorporate some in-the-money contracts under, say, 40, which would be a higher delta opportunity for the long call trader here. And then the next question is, if you're the option trader, do we incorporate the earnings announcement on the 6th, which would mean we'd have to go out not to August 1, but August 8. And so that's the conversation that a trader's likely having. Do I want to trade this for the next 7 trading sessions, or do I want the next 12 and to at least incorporate the opportunity to consider earnings, right? So we do know that if we looked at the trade tab on IonQ, that for the 1st versus the 8th, we can get a pretty clear picture that there's more volatility on the August 8 expiration versus the August 1 expiration. That tells us we're going to pay more to participate with the August 8. However, don't be misled that if you're using the August 8, that you somehow have to hold it into earnings. You don't. If you get the move sooner, many traders would just go ahead and say, I don't want to take the risk associated with earnings. I'll take any profits I have in advance of that earnings announcement. This way, though, they could benefit from any implied volatility increase between now and that approximate date of August 6th, when expectations for the earnings hit. So that's one way to think about it. Let's do a brief, quick call spread on this one, where we can go long at, say, the $40 strike, and then maybe short the $45 strike, which would be cost effective, but give us an opportunity for profit nonetheless. So let's look quickly at how that'll look, everybody. A $40 call with a $45 short call for the August 8 window. I'm going to hold the control button down, click the bid, and now we've got it built in. Remember that the profit opportunity is the difference between our strikes less our cost when we are considering a long spread like this one, a long call spread. Now, we could go higher in price, right? In fact, just real quickly, let's see how this might appear. If we wanted to go and make it, oh my goodness, the premiums are great here. You can make it an $8 spread. It's going to cost us more, right? So what if we change to 48 here? Okay. Now our mid is more like 288. So we're going to spend a little bit more for that, but now we've got an opportunity to make about 5 points. So that's one way to work through this, everybody. Just look at the values associated with your contracts and decide, hey, I could spend $90 more for the opportunity to make a couple hundred more. Many traders would look at that and say, I can understand why I'd consider that. Or they might say, you know what, I like the smaller spread. I'm going to go with what I've got. For our purposes in this example, let's go with the $8 spread here. Let's see if we can turn this between now and next week the direction we want, and see if we are right about the potential for this trend. So we'll confirm and send. We're buying one vertical for the August 8 expiration, the long 40, and then we're going to sell the 48 against it. We are capping our upside, but we are looking at a potential to make as much as $510, the difference between our entrance and the $8 spread. So let's send that off, and we are in it. Great. So now I'm just going to jump back to my monitor tab, and I'm going to place that from my unallocated portion. I can't move the lunar trade yet because it's has not executed, but I can move the IonQ into our trading price pattern. So we'll discuss that one next week, everybody, hopefully in a positive sense. So thank you all for joining me today. Hope the conversation was helpful. I know we didn't review, 10 different positions, but I find that by reviewing maybe 3 to 4, we can talk more about the detail around the position, the opportunity for consideration, and the things traders want to know about and think about. So hopefully y'all got something from it. I'd love to hear from you. Don't forget, you can follow me on X, Kevin Horner CS. Do the same for Brent Moore CS. And if you liked the conversation, hit that thumbs up for us down below. I'm going to update some notes, get this into the archive for you here this afternoon, everybody. So thanks for being here. I hope you all have a great rest of your Wednesday. I look forward to following up with you again real soon.